The yo-yoing that is markets continues this week. Monday, risk off. Tuesday, risk on. Wednesday, risk off. Stocks have come back under pressure and look to now be settling into a consolidation phase ahead of the next big move. Sour trade deal developments have worked their way back into the market, a primary driver of this risk liquidation today. But whether or not that move that we see next results in fresh record highs in stocks or a new monthly low remains to be seen. Whatever the case, fragility in the global economy should be a concern, and with this now paired up with exhausted central bank policy accommodation and government stimulus tools, investors' immunity to downside risk doesn't look like it will be the same as it once was. On the currency side, the euro and pound haven't done a whole lot. The yen has rallied as it tracks correlations with equities, while risk-correlated commodity and emerging market FX are under pressure. The Canadian dollar has taken an added hit on Wednesday as oil prices reverse course back to the downside. On the data front, UK inflation reads were the most interesting today, coming in well above forecasts, supporting the pound against offsetting bearish flow from ongoing stress associated with Brexit. But to see earnings and inflation in the UK moving up as they have, it makes the case for the pound that much more compelling if we can get back to a place where that no-deal tail risk looks more like what tail risk should look like, as opposed to the base case type risk the market has been pricing. Other data on the day was less encouraging, as reflected through softness in China and German prints. China industrial production and retail sales missed and were followed up by a second quarter contraction in German GDP. Yield curve inversions were also a story on Wednesday. In the U.S., the 2-year, 10-year yield curve inverted for the first time since 2007, a rather unsettling event, and we got the same 210 inversion in the UK for the first time since 2008. Of course, it was impossible to ignore the drop in the U.S. 30-year yield to its own record low. That's all for now.